OpenAI just locked in billions in AMD chips, and in the same deal, got rights to own up to 10% of AMD's stock. I guess now even AI companies have buy one and get one deals. But if you think that was one-off, zoom out. The big AI players build what I call the AI Centipede. Nvidia backs OpenAI. OpenAI runs on Oracle. Oracle buys more Nvidia, AMD just joined, and CoreWeave rents Nvidia chips to the group. Nvidia, AMD, Oracle, OpenAI, and Microsoft, over $10 trillion combined valuation, are buying, investing, and hosting inside the same circle. Is this real growth or a round-trip game like Enron, AOL Time Warner, and Cisco from the dot-com days? One could even say we're witnessing the biggest Ponzi scheme in our lifetime. In this video, I'll expose the AI Centipede, the money loop propping up the biggest names. I'll break it down piece by piece, the market's overconcentration, how small surprises can wipe trillions in a day, and what you can do to protect yourself. If you're wondering why you should even listen to me and you're new here, I'm the Trading Actuary. I'm an actuary by trade who spent over 10 years managing risk and forecasting billions for Fortune 100 firms. Now, I run my own firm specializing in AI, risk assessment, and business intelligence. I bring that same risk-focused mindset to the market, and I've been doing this for almost a decade. My goal with this channel is to share that knowledge with others who are just as passionate about finances, the economy, and the markets. I also run a free newsletter with trade ideas, chart setups, and much more. If you want to join hundreds of traders and market enthusiasts who are already using it, the link is in the description below. Now that you know who I am, let's get this started. Every day, it's the same script. New AI data centers being built everywhere, big chip orders, and CEOs that say demand is endless. Dips are being bought, and bad earnings are being completely ignored. They prop this up like it was bulletproof. Then, one tweet from President Trump about renewing China tariffs, and the market did a full 180. Nearly a 4% flash, erasing over $1.5 trillion in a single day. And the kicker? The same companies pumping these insane valuations were the ones that got hit the hardest. We'll come back to that later. But first, let's set the scene with the AI Centipede. As you can see, Nvidia is the center of it all. Nvidia backs OpenAI with up to $100 billion and supplies GPUs for a planned 10 gigawatt build-out, equity on one side and chips on the other. OpenAI runs on Oracle under roughly $300 billion compute deal. Oracle buys billions of Nvidia GPUs to serve those workloads, then books the hosting revenue back from the same group. Those margins, though, aren't magic either. Internal numbers put Oracle's AI cloud around 14% gross margin for last quarter, and nearly $100 million loss on Blackwell GPU rentals. OpenAI will also use AMD, and AMD gives OpenAI the option to buy shares up to $160 million, or roughly about 10% of the company. Chips in, equity out. Microsoft stays the Stargate enterprise partner. xAI is raising up to $20 billion to buy more Nvidia chips, with reports of up to $2 billion of Nvidia equity. CoreWeave rents Nvidia chips to OpenAI and others, a middleman that keeps the loop spinning. Intel sits in the AI infra stack next to Nvidia, just another knot in the circle. I know this looks confusing at first, but hope this can explain it better.
How about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10, I owe you 10.
Thanks. Hey, Mo, you owe me 20. Well, here's 10, I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you. Here's the 10 I owe you.
Good, now we're all even.
The point is, most of the money never leaves this group. It changes hands, bounces around, and creates the illusion of new demand. And while that cash is doing laps, two things keep poking through the smoke: policy and insiders. First, let's take a look at policy. The US just okayed several billion dollars in Nvidia exports tied to the UAE, including projects for US customers such as Oracle. Change one rule, and the chips and the money go right back to the same few companies. Second, insiders. Nvidia's CEO sold about $42.8 million of stock this week, in addition to over $800 million he sold a few months ago. When leaders sell into strength, that's a classic tell. Now imagine a bigger wrench that clogs the AI cycle, tighter export rules, a supply hiccup, or a missed milestone. If one tweet can drop the markets almost 4% or $1.5 trillion in a single day, imagine what a real clock could do. On capacity, Microsoft also unveiled a new Azure cluster with 4600 plus Nvidia GB300, which is the Blackwell Ultra GPUs for OpenAI, as the first of many. The build is real. The question is, does cash demand match the capacity story? Now you might be wondering, is any of this even legal? The short answer is yes, it is legal, at least based on what's public information. But what doesn't make it healthy or broad demand, it's the same loop with great PR. So why does this loop keep working? Well, stories pay first, cash later. Say AI is endless and people throw their money at it. Prices rise even if profits don't. Stock warrants look great when stocks rip. Guidance sounds strong, but cash flow is slow. Hardware is expensive, power is also expensive. Real paying use cases take time. The gap between story and cash is where the bubbles form. We've seen this kind of thing before. Enron with the round-trip trades, AOL Time Warner ad swaps, Global Crossing and Quest swapping bandwidth, and Cisco sold mountains of network gear into telecom build-out that later collapsed. Different times, different companies, but the same incentive. Keep the story hot so the price does the work. So why should you care? The market is over-concentrated. A handful of mega caps drive the index and set the mood for everyone else. The top 10% of the US stocks make up over 75% of the whole market. In the S&P 500, the top 10 names are about 38% of the index, and the top 5 are 28%. And the tech's share of the index is back near the dot-com peak levels. So what does that mean? If one or two names wobble, your SPY, your triple Qs, even your 401k can swing fast. You don't need to own a single AI stock to feel it. Index funds carry the same names. That's the risk. We think we're diversified, but we're crowded into the same leaders. Palms are euphoric, but sellouts hit harder. And we saw an example of that last Friday. The king is naked. Everyone sees it, but no one wants to say it. I'll cover how to protect yourself and the simple plan that I use at the end of this video, so stick with me. But while at it, don't go into the week blind. The newsletter gives you the game plan for the week, key levels, the top chart setups, and the trade ideas I'm tracking. I send 2 newsletters per week, and it's completely free. The link is below. Make sure you sign up. Now, before we get to the solutions, let's go through the weekly calendar and earnings reports. If you don't care about this, then feel free to skip forward. With the government still in shutdown, some reports are paused, but earnings season kicks off with big names this week, so please pay attention. On Monday, we have Columbus Day holiday, and we have some Fed speaker. On Tuesday, we have NFIB Small Business Optimism. On Wednesday, we have CPI, Empire State Manufacturing, and Fed Beige Book. On Thursday, we have retail sales, PPI, jobless claims, Philly Fed Manufacturing, business inventories, and homebuilder confidence. On Friday, we have housing starts, building permits, import price index, industrial production, and capacity utilization. On the earnings front, on Tuesday, we have BlackRock, JP Morgan, Goldman Sachs, Citigroup, Wells Fargo, Johnson & Johnson, Domino's, Ericsson, and Albertson. On Wednesday, we have ASML, United Airlines, Progressive, Dollar Tree, Bank of America, Morgan Stanley, and Abbott. On Thursday, we have TSMC, Interactive Brokers, Charles Schwab, Commercial Metals. On Friday, we have Ally Financial, State Street, and American Express. Alright, that's the week ahead. Now here is what to do. Bottom line, watch the money, not the marketing. Circular deals can float prices until one link snaps and the whole chain breaks. Don't be the one holding the bag when the emperor gets a mirror. Do this next. It's a very simple plan. Check your exposure. Open your positions. If you're over-leveraged or one name is dominating your account, trim or rebalance. Set guardrails. Choose a max loss per trade that fits your risk. Use stops or alerts so one headline can't wreck your week. Hedge the big days. Around CPI, jobs, and mega earnings, consider simple protection, a covered call, a put, or a put spread, instead of just hoping everything will be great. Take profits on strength. Trim into reps, but reload on resets if the thesis still holds. Keep a cash buffer. Some dry powder lets you play offense when others panic. Use levels, not hope. Mark your lines. If price breaks a key level, then you need to respect it. Watch the news risk. Set alerts for traffic or export rules, AI project delays, regulators, and any insider selling. But how can you avoid the Ponzi scheme in the first place? First, how to spot it fast. If consumer, the supplier, and the investor are the same small circle, the pitch is build now, profits later, and the headlines are loud, but the money never really leaves the group. If you see any of that, you're looking at the loop. Now, what to do depending on your lane. If you're investing for the long term, stick to real cash flow from the outside of the circle. If most of the revenue is coming from partners in the loop, then it's a hard pass for me. Keep your size in check. If one name or margin is taking over your account, trim or rebalance. Protect the core on risky weeks with a small index hedge instead of hoping. And keep some cash so you can buy when others panic. If you're trading short-term momentum, trade the tape. Take profits on pops and move on. Use stop losses so one headline doesn't erase your entire week. Pick your dates. Around CPI, jobs, and mega earnings, run lighter or hedge. And skip YOLO leverage. No oversized bets, no averaging down in a free fall. Look for new customers outside of the circle. Round trips don't count. And look, my Twitter feed is full of horror stories right now. It's full of I am dumb posts and accounts blown up overnight. Some are real, but some of them are fake and are just farming for engagement. But the lesson doesn't change. Wrong sizing plus high leverage and plus no hedging is equal your account gone. Don't be the screenshot. If you want the exact way I prep each week so I don't end up in those posts, grab the free newsletter. The link is below. You'll get my weekly plan, the key levels, top setups, and the trade ideas I'm exploring delivered pre-market so you're ready before the bell. If this helped, hit like and subscribe and drop a comment below. What do you think? More runway for the AI loop or is the reversal starting? And was Friday the first crack? Before you go, you want to see where the smart money is rotating next. Watch my video on the top 5 areas smart money is rotating next. I break down the 5 pockets catching flows now and the names on my watch list and how I think about entries and risk. If you're still heavy AI, treat this as your plan B. Get there early so you're not the exit liquidity. Thanks for watching, and I will see you in the next one.